In 2015, a Pakistani bank was sold for just 1,000 rupees. That was KASB Bank, a rare case of failure in an otherwise healthy sector. But today, a much larger problem is brewing. Pakistan's entire microfinance industry, managing nearly ₹1 trillion in assets, is losing money. And that has been since 2019. So what went wrong? And is there a way out? Mutahir Khan broke it down for Business and Finance Weekly. Let's start with the numbers. In the first quarter of fiscal year 25, the microfinance sector pointed net losses of 2.3 billion rupees. Capital reserves have dropped for 12 quarters in a row, now down to just 1.2% of risk weight assets. The minimum required is 15%, unlike the KASB case. It isn't about one or two weak players. This is a system-wide. Microfinance banks serve low-income and rural communities, and these groups have faced major shocks. COVID-19, followed by widespread floods. Harith Chaudhry, CEO of MobilLink Microfinance Bank, says the impact on customers has been direct, and so has the pressure on the banks. But Mr. Chaudhry argues that we are looking at the wrong metrics. He says success should be judged by social outcomes, not just profit. Over half of agricultural lending in Pakistan comes from microfinance banks. Nearly half of all mortgages are underwritten by them. Since 2017, 141.5 million financial accounts have been opened, two-thirds of them branchless, powered by mobile wallets. And when it comes to outreach, microfinance outspaces traditional banks. 9.28 million borrowers in 2024, including 1.7 million rural clients. That's double the loan base of scheduled banks, despite their asset base being 55 times larger. MobilLink Microfinance Bank stands out. It holds 18% of the sector's total assets, maintains capital adequacy ratio of 19.16%, which is well above the requirement. But even MMBL couldn't avoid losses this year. So where's the hope? Mr. Chaudhry points to two trends: digital wallets and nano loans. These are short-term, low-value loans accessible through mobile phones. While not highly profitable, they offer sustainable returns if managed well. His bank has seen a return on equity of 18%, but there's a catch. Most microfinance players haven't invested in tech, systems, or proper risk management. As a result, the state bank is actively seeking new sponsors. Recently, it facilitated the sale of Finca and Advance to Fintech from Pakistan and Egypt. Abhi with TPL and M&T Holland, the idea is to pair technology with financial access to bring returns back into the sector. Even digital-first players like MMBL are expanding branches, now at 113. Why? Because in person, customers deposit more. This pattern holds true beyond Pakistan. Still, Mr. Chaudhry believes microfinance bank can be vital partners for scheduled banks, helping expand reach and meet national financial inclusion goals. His biggest ask? Let microfinance banks handle inward remittances. Right now, only scheduled banks get full incentives for this. Level the playing field, and he says the sector could finally stabilize. So can Microfinance Pakistan turn things around? It depends on how we measure success and whether new players are ready to invest in technology, governance, and smart partnerships.